In this week's video, I'll be explaining the 2023 freight market and the events that led up to it. The original source of this content is Dean Krog's weekly market update released on DAT. It's a great perspective on what happened in the previous handful of years that has contributed to last year's market and how it played out, and it provides some insights into what 2024 may hold for all of us in the industry. And as W.C. Fields once said, time and again, history repeats itself. The only difference is the actors change. I'm Benjamin Kowalski with Freight 360, where we provide the latest transportation sales tips and training videos to help you reach your goals faster. If you're a fan of the content, please support us by crushing that like button and sharing us with all of your colleagues. For more information on our Freight Broker course, Freight Broker Basics, be sure to click the link in the show notes or go to freight360.net for more free training material. Last year will go down in the books like 2019 did. An unprofitable year for carriers with the usual twists and turns. Unlike 2019 though, we have not seen anywhere near the level of carrier bankruptcies reported, despite the number of long-haul carriers that have exited the market. To put 2023 into context, we must go back 5 years and start with the 2018 bull market. The first half of 18 was an excellent year for carriers, especially flatbed carriers. It was boosted by great industrial economy, rising oil prices, and significant rebuilding efforts following Hurricanes Irma and Harvey in late 17. Changes in the tax code also benefited carriers that placed a record number of orders for new trucks later that year. Owner-operators and small fleet carriers made an average of $24,000 gross profit after all expenses during the year. And by all accounts, it was really a good year for everyone in trucking. But as demand cooled into 2019, the industry became increasingly oversupplied as new trucks hit the road following the frenzied buying spree of new trucks and trailers 6 to 9 months earlier. Now, downward pressure on spot rates came next, and it resulted in a lot of bankruptcies in the second quarter of that year, including some of the mega carriers, Falcon, Celadon, and New England Motor Freight. Approximately 640 carriers went out of business in the first half of 2019. That's up from 175 for the same period last year, and more than double the total number of trucking failures in 2018. The net result was a poor financial year for carriers in 19. Average gross profit levels dropped into negative territory, compared to 18, when small carriers had a net income average of $24,000. 2019 saw carriers lose an average of $2,000 gross profit for the entire year. The first quarter of 2020 continued much like 2019 did, with carriers dropping capacity to match the declining freight market. That was until March 11th, when the World Health Organization declared a global pandemic. The pandemic was unprecedented, but so was the long-term impact on our trucking industry. The pandemic upended the freight market, demand crashed, and drivers sat idle on the side of the road. Consumers of freight hunkered down at home, increasing their spending on e-commerce, and carriers took advantage of whatever financial assistance they could get to weather the storm. And when the Paycheck Protection Program, or the PPP loan applications, stopped mid-year, the freight market recovered as demand returned, and most carriers came back off the sidelines. What happened in the next 6 months, or the last 6 months, of 2020, was nothing short of remarkable and set the stage for an unprecedented doubling of for-hire truckload capacity in 2021. From June to December of 2020, two things happened that kickstarted one of the most profitable 18-month periods in the entire trucking industry's history. First, in the second half of 2020, diesel costs dropped 23%, or 71 cents per gallon, bottoming out at $2.37 a gallon. Over the same time frame, dry van line haul rates increased almost $1 per mile, from $1.85 to $2.80 a mile. or an increase of 51% by the end of that year. The spread between fuel and spot rates created higher margins and catalyzed the doubling of long-haul capacity throughout 2021, when carriers made record profits and paid down their debt. Toward the end of 21, long-haul carriers made upwards of $1 a mile gross profit, or the equivalent of $100,000 annually after all costs were considered. The 2023 freight market is still feeling the effects of this 3 years later as carriers exit the market, but at a much slower pace than most people expected. Carriers of all sizes used the boom to sell excess equipment and property, building massive war chests and savings accounts compared to previous years. They also became more selective of the loads on offer from brokers. And throughout 2021, they ran 10,000 fewer miles, averaging 85,000 miles for the calendar year. According to Todd Amon at ATBS, Amon told DAT Freight and Analytics in late 2022, for the first time ever, we're seeing carriers electing to sit out the market as diesel prices spiked over the summer, something we've never seen before. For some, the runway was nearing the end though. All of that changed when Russia invaded Ukraine February 24th, 2022, sending diesel prices sky high and global demand in the opposite direction. By then, many carriers had seen the writing on the wall and were already getting out of the market, realizing that the good times of 2021 were in the rearview mirror. For others, surging diesel prices and falling spot rates meant they realized they were no longer viable. There was an exodus of carriers in April and May as spiking operating costs resulted in them being unable to pay their bills. And for long-haul carriers in 2022 ended up a mixed year, which started great but gradually deteriorated due mainly to diesel prices reaching a record high of $5.81 a gallon in June. And another wave of carrier exits followed in September because those carriers struggled to afford their monthly fuel and finance bills. Despite this, carriers still made a $41,000 gross profit average in 2022, around half of what they made a year earlier though. The carriers that remained in the long-haul sector were drawing down heavily on their cash reserves that they put away in 2021. And for the most part, those reserves were running out as the perfect storm of both low rates and high fuel costs gripped the late 2022 freight market. 2023 and the predictable rainy day arrives. Following the massive buildup of shipper inventories in 2021 and 22 and decreasing freight demand over the year, carriers could still break even in 23, despite the roller coaster ride that diesel prices were taking carriers on. From the end of January to Independence Day of last year, diesel prices fell by 18% or 84 cents a gallon, a welcome reduction in operating costs of approximately 8 cents per mile, allowing many carriers to stay in the industry a little longer as rates continued to fall. In the ensuing 10 weeks following the 2023 Independence Day weekend, diesel shot up 23% or 86 cents per gallon, erasing the prior 6 months decline and resulting in the third highest number of carrier exits to the industry in October. Since then, diesel prices have dropped nearly 15% or 70 cents per gallon, slowing the rate of carrier exits. The 2023 freight market ended with more trucks than there was freight, loads to move. Despite this, long-haul carriers broke even by year end after making the equivalent of $3,000 annual gross profit for the first half of 23, but losing the same amount of money in the year's second half. Compared to the second half of 19, the second half of 23 was almost identical, with carriers in negative profit territory for much of most of it. Now, most long-haul carriers were getting by but needed to generate more profit to survive long-term or to be able to pay for significant repairs. Many are still one major breakdown away from going out of business. Now, 2024, a turning point. We start this year with the market capacity rebalancing and carriers exiting the market, albeit at a slower rate than a year ago. Surprisingly, carriers continue to join the industry, fulfilling the American dream of starting their own businesses. If they can survive the first quarter of this year, when rates are sure to drop along with freight demand, as they always do this time of year, they will thrive when the market turns, hopefully this spring. One thing is for sure, fewer trucks will be available to move higher freight volumes when the freight market does turn. And that means higher freight rates and improved profit margins. Spot truckload rates rose in December of 23, and the gap between the spot and the contract van rates closed to its narrowest point since March of 22, when prices to move truckload freight were near all-time highs. Now, a convergence, right, of the spot and contract rates as they get closer together would signal an end to the current cycle of falling prices for truckload services. The price to move van freight under contract hit its lowest point in 3 years. Entering 2024, shippers are still in a strong position as they negotiate their contract rates. However, carriers in the spot market are starting to see the light at the end of the tunnel. The good times should return this year, but unlike 2021 and the boom we saw then, it will be more like what we saw and experienced in 2018. For more tips on building successful freight brokerages, check out our website, freight360.net, and for more information on our freight broker course, Freight Broker Basics, well, you'll learn everything you need to know to earn a living as a freight broker and what it takes to build a successful freight brokerage.